Welcome to the Finance Garage podcast, your go-to podcast for navigating the world of finance. I'm Jonathan, your financial guide, bringing the latest market trends, investment strategies, and financial news that matters to you. And by the way, I'm also going to share my other passion, which is cars.
At the SWU Group, we help everyday families achieve financial success. Our integrated services include financial planning, accounting, credit advisory, and estate planning. We're here to guide and support you every step of the way, from custom investment strategies to maximizing tax efficiency. We ensure your financial goals are met with peace of mind. Visit simonwu.com.au for more information.
Hey everyone, welcome back to the Finance Garage. As always, it's Jonathan Wu here, Senior Financial Advisor and Principal at the SWU Group. And as you know, on this podcast, we come out with two pieces of content a month. One, where I'm having a conversation or an interview with someone from the investment or the car scene. And the other is myself talking about something that's been on my mind lately. This month, the topic is around self-managed super funds. And we're going to sort of break this podcast up into three different parts. The first part's to talk about the latest trends we've seen from the latest round of ATO data that's come up around SMSFs, sizes, what they're investing in. I then want to talk about a little bit of bugbear of mine, which is small-sized self-managed super funds and the problems associated with them that most people do not know about. And then furthermore, a compounding problem is small self-managed super funds holding direct property. So we're going to talk about these three things today, and hopefully you'll get something useful out of it. Now, as always, everyone's situation is different, and everything that I talk about today is not personal advice. And you should definitely seek the advice of your accountant or your licensed financial advisor before acting on anything I'm talking about today. So if we first off kick off and talk about the latest stats for SMSFs from the ATO, we're talking about data ending the quarter of 30 June 2024. And one of the most interesting things is that during this quarter, there were 8,613 new funds that were opened up. And this is actually the highest quarterly growth we have seen in SMSF setups since 2018. Because in the same quarter, obviously, just as many self-managed super funds may be open, but there's always a portion of self-managed super funds that are closed. And in actual fact, there were about 3,000 closed during the quarter, meaning that the net number of new SMSFs created for the quarter ending 30 June this year was about 5,600. If we then look at the whole financial year, or FY 2024, there were net around 27,000 new funds created. And this net figure is actually more than double that of the 2023 financial year. All up in Australia, we now have 625,000 self-managed super funds across 1.15 million members. Now, this represents that pretty much most self-managed super funds on average have 2 members. And as most of you know, a self-managed super fund now can hold up to 6 members, and obviously a minimum of 1. There has been a consistent, steady growth in self-managed super funds. I guess a number of reasons, just anecdotally as an advisor, seeing this day in, day out. There's a population of people that obviously want more control over their super, and so self-managed super fund gives them that choice, especially compared to industry super funds, which a lot of times you don't really have the ability to dig deep into their asset allocation, understanding individual strategies that they're employing to generate a certain level of return based on a certain risk profile. There are some investors that like to invest in direct equities, and there is a portion of investors that like to invest in direct property, which is obviously something I'm going to talk about a little bit later on. But given the fact that we've seen APRA heat mapping come up in the last couple of years, where effectively there is a name and shame policy by the government regulators as to the outperformance or underperformance of industry super funds, especially, that this has shone a spotlight on them and effectively hamper their ability to take risk in many cases, because if they take excess levels of risk and it doesn't work out in their favor, they will be on the name and shame boards at the end of the year when APRA releases those heat maps. That has then created a more concentrated way for especially industry super funds to invest, and therefore the long-term future or the long-term growth of SMSFs will actually be almost structurally in place, because first off, you have new members coming in that they're getting their 11%, and over time we'll get to 12% worth of SGC each year. This naturally keeps growing, and people also will take more notice of their super given the impacts that it could have on their long-term retirement wealth situation. Because from the statistics, what we can also see is that the young people are also seem to be driving this recent growth in self-managed super funds, because over the same quarter through to 30 June this year, just over a third of new members were actually aged between 35 and 44. And this is well below the average of the average age of an SMSF member, which is 45. Still of which, about two-thirds, or just under two-thirds, 64% of SMSF members remain over 55 years old. The growth of the total sum of SMSF assets have also grown considerably, and SMSFs now control over $990 billion of assets, and this represents around a quarter of all superannuation in Australia. And we rightly expect that this will actually continue to grow. As I said, this is also going back to that APRA heat mapping issue. And in a couple of months' time, I will have Mike Taylor, who is an industry veteran, who is currently the managing editor of Financial Newswire. Formerly, he was the managing editor for 25 years at Money Management, to come on and talk about APRA heat mapping and the future of superannuation given these increased constraints to sort of thinking out the box, or basically targeting a higher tracking error for their investment options. The average size of an SMSF, as at the 30th of June this year, was $1.55 million. And so if we then work that out as an average assets per member, you're looking at about $835,000. And this compares simply 5 years ago, back in the 2018-19 financial year, the average assets per member was around $680,000. And the average size of that SMSF, as I said, which was $1.55 million today, 5 years ago was 1.27. So you can see that the size and scale of these SMSFs are growing. And remember, these include funds that are $5, $10, $15, $20 million in size. And then you've got the $100,000 and $200,000 super funds, which is an area that has been a bugbear of mine for quite a while. If we consider the total size of the SMSF market, that is funds that are less than $500,000 in size, we're looking at about 40% of the market. If we're looking at funds, not 40% of the market, about 30% of the market. If we're looking at funds that are less than $200,000, we're looking at about 13% of the market. So it's still reasonably material. When clients come to us at the SW Group, for example, and ask about self-managed super funds, my rule of thumb has been not to actually engage in a conversation unless they're considering at least about $1.2 million. Most of that has to do with two primary concerns of ours, which is one around diversification, the ability to adequately diversify, and number two is the cost. Okay, cost is a big thing. Cost of living in the general scheme of things is also becoming quite material. But the reality for us and our clients is that we want to find the most effective way for them to grow their wealth. And for some of them, that's self-managed super funds. For a lot of them, it's still not. Okay, because as the statistics show, while it is quite large at 990 billion Australian dollars, that's about a quarter of all superannuation. So size is an issue, which I'll come back to in a minute. If we then look at the actual breakdown of how SMSFs are invested, there was a couple of figures that sort of surprised me, given the prevalence of marketing LBRAs, which are called limited recourse borrowing arrangements. So effectively using a self-managed super fund to borrow money to invest in direct property. And that number is actually a lot lower than I had thought. So again, looking at the 12 months to June, the predominant amount of investments in self-managed super funds is listed shares at around 28% of an average fund. If we then add in listed trusts as well, which is about 6%, you're basically looking at about a third of the fund is listed assets. Then you've got unlisted trusts and other managed investments, which total another 20% or so. And then actual residential property as a percentage of the average super fund size was only 5%. And this is where I'm going to come back to in the third section of today's podcast, talking about small-sized self-managed super funds, then investing into investment property as a strategy. What we then also see is that SMSFs with around $5 million or more, they actually held more in unlisted trusts, listed shares, and then they actually held less as a percentage of their fund in cash and term deposits compared to smaller SMSFs. Now, broadly speaking, one of the key conceptual issues that jumps out at me is because SMSFs need to maintain a reasonable level of liquidity, which again is going to be something that we talk about with regards to holding direct property within SMSFs going forward. And as your fund is growing larger, you actually need less cash and term deposits to fill that liquidity gap. But if your fund is, say, $100,000 or $200,000, you obviously need to hold a lot more cash to maintain the liquidity in the market. And so the statistics show that not a lot of property is, and not a lot of money is going into direct property as a percentage of the entire superannuation market. But there's a lot of groups out there that have, over the last 2 decades, marketed the strategy of opening up a self-managed super fund and then tacking on a property. So if we actually discuss and look at the issue of small-sized self-managed super funds for a minute, of which about a couple of years ago, there was a new client that came up and said, I have $200,000, I want to open up a self-managed super fund. And I questioned why this particular gentleman wanted to do that. And he said his primary driver was that he wanted to trade his own shares and he believes he can make 50% a year. Now, he wasn't after investment advice. He was simply after an accounting firm that could open up a self-managed super fund for him. And we actually declined, solely on the basis that we felt that there was probably another practice that could serve him better and his needs. A lot of the costs, and this is probably the first of 3 reasons why small-sized SMSFs can be problematic, is the high costs relative to the balance of the fund. There are a lot of fixed costs in running an SMSF. That includes audit, compliance, administration, which is generally the accountant's costs. And this can be disproportionately high for smaller balances, reducing the fund's net return over time. Because if you consider if your total cost to run a fund, including audit, admin, so on and so forth, let's call that $6,000 as a round number. If you have $100,000 in that self-managed super fund, that's 6% a year. And that's a pretty high hurdle to jump over in terms of what type of investment strategy do you have to be in to actually get to that point where you're actually generating a return well above the cost of actually maintaining your self-managed super fund. This is why my general line and rule of thumb is if a client's in a retail product, we're looking at about $1.2 million before the consideration of a self-managed super fund to effectively match the costs associated, and if there's any growth over and above that, there are some cost efficiencies. Now, differs from client to client, depends how many members we're looking at for a newly formed self-managed super fund. And we're also looking at what I like to call the runway of growth. And the runway of growth refers to not so much about investment returns, that's something that none of us can control, but the actual growth vis-a-vis contributions, whether that be, other assets that are held external to the super fund, like investment properties that want to be sold down and contributed as after-tax contributions, or maximizing concessional contributions for tax efficiency, Or if we're looking at sale of a business and the business proceeds, there are a number of different capital gains concessions that can be used and offered by the ATO to reduce or increase tax efficiency as well by contributing it into super. So that runway of growth, if we're looking at a fund that's generally smaller, is also just as critical as what they have today. The second reason why small superannuation SMSFs are burdensome is the limited investment opportunities. Okay, so just like in the personal investment sphere, you've got retail products, you've got wholesale products. And the increased prevalence of wholesale products, investment opportunities coming into the market has significantly increased in the last decade. And you need to pass the sophisticated investor test or the wholesale investor test, which is one of two tests that you either have $2.5 million in net assets, investable assets in the market, or you are earning at least $250,000 of taxable income over the last 2 consecutive financial years, and an accountant must issue you this letter proving this. Now, from a self-managed super fund perspective, the simple way to put it is if your self-managed super fund is over $2.5 million, you can consider these. If you're a small self-managed super fund, your investment opportunity set has become more limited. And another of the reasons why we actually look at considering self-managed super funds for some of our clients, which are currently in retail land or in the industry super fund land, is because their balance is high enough to then effectively, within inverted commas, graduate to be able to access those wholesale investment opportunities. Now, the key difference, obviously, between retail and wholesale is that wholesale products have no product disclosure statement. They're issued under what is called an investment memorandum. There is no prescribed form of this, whereas a product disclosure statement, when you buy life insurance, car insurance, health insurance, or any other managed product, has a product disclosure statement that goes into quite a lot of detail, whereas wholesale products do not. This does not reflect that wholesale products are necessarily more risky, but it means that asset managers and other people providing these opportunities can bring it to market relatively quicker. In saying that, there are still plenty of investment options in retail world, but the smaller the fund size, obviously you simply can't diversify effectively. If you can't diversify effectively, then obviously that increases investment risk, which again, we'll go back to the third part of today's podcast talking about investment property.
Ready to take the first step in investing, or just looking to continue growing your wealth without being inundated with financial information? With SWU Online Invest, we offer a range of expertly managed portfolios designed to match your investment needs. Whether you're a seasoned investor or just getting started, know that we will work tirelessly to ensure your investments are strategically positioned to maximize your goals. Visit swuonlineinvest.com.au today.
The third major issue around small self-managed super funds is the amount of effort required for ongoing management and compliance obligations. And if it's too small, then it doesn't justify the member, therefore the director of the trustee or corporate trustee, to justify the time and effort involved. And this is probably another area that we come across where clients talk to us about the cost of a self-managed super fund. Because one of the things that we advocate for, broadly speaking, is that self-managed super funds set up should use corporate trustees in most circumstances, because it actually reduces the risk. If a certain member was to pass away, the administrative burden is nowhere near as high when one of those members passes away, and the estate planning benefits that flow on for a self-managed super fund utilizing a corporate trustee is far more effective. The issue is that clients say, well, I have to open up another corporate trustee Pty limited company for the purposes of my self-managed super fund. Well, that seems extreme, and it's another cost burden. Why do I want that? And so when you consider that administrative burden, if the super fund's quite small, is there any marginal benefit in having a self-managed super fund? Now that leads me into the third point, and the third point being the issue around using a self-managed super fund that is small in size to buy property. And especially if you're using a LRBA, or as I called, the limited recourse borrowing arrangement. The sales pitch that a lot of people have received and the feedback that we've received from the market is that generally someone will come to them spruiking, opening up a self-managed super fund, claiming all the benefits, including great control, so on and so forth. And then they're generally linked to a real estate developer or real estate agent and then on-sells you a property. Now, I'm not so much talking about conflicts of interest here. You know, those sometimes are unavoidable, but there's issues that that clients do need to address and deal with, and the professionals themselves. But if you're rolling 100K or 200K out of an industries fund or a retail fund to open up an SMSF to then house an investment property, you could run into a lot of issues. Again, you go back to first principles around superannuation. And what is the purpose of superannuation? It is to provide for your retirement. Now, when you hold an investment property in your own name, there are a lot of benefits. And this is obviously the political issue that's been going back and forth for years is what is the relative benefits of negative gearing? And negative gearing, as we know, is effectively the strategy whereby you gear a property heavily, invest in your own name to derive a lot of tax benefits because the interest is tax deductible, the depreciation is a tax deductible item, which leads you to become cash flow negative or tax calculated negative cash flow, and therefore you derive a tax benefit. Now, if you consider the effective tax efficiency of a negative gearing strategy, obviously the higher your marginal tax rate is, the more derived benefit within inverted commas you get. This is why people do it. But superannuation in of itself is a concessionally taxed environment. So instead of the highest marginal tax rate in your own name is 47%, the highest marginal tax rate within superannuation broadly is 15%. And then by extension, capital gains, including the discount, is 10% maximum. If you consider that within the context of if you had no other income and then bought a property to heavily negative gear, it doesn't make a lot of sense because there's not a lot of tax benefit. Same thing with an investment property within super. Now, the key sales tactic that we've seen in the market is effectively the pitch of, do you want to have a self-managed super fund holding a direct property, and when you retire, you get to sell that property tax-free? Strictly speaking, that is correct. And strictly speaking, there's nothing wrong with that strategy. But I always then lead with the next statement of, at the cost of what? At the cost of liquidity risk, because your property may not generate the cash flow required in retirement to pay out a pension. So for example, someone over age of 65 needs to pay 5%. The average yield on investment property in Sydney is around 3% at the moment. So where's the benefit derived there? Then all the costs of that property, strata fees, council rates, and the interest have a lower tax efficiency or tax benefit derived from it because that's the way concessional tax rates are within superannuation. And then furthermore, you have the concentration risk because you effectively can't hold much else than that that investment property within the self-managed super fund because your fund itself is quite low. Which then means you've got lack of diversification risk. And all your money is lumped into one area to fund your potential retirement. This then also hampers growth because it limits the opportunity to invest into other things because you simply have limited capital. And then further to that, there are excess levels of costs with regards to maintaining a property. So if your expense line, which is compounded by the expense line of managing the SMSF itself, without including the fact that you have an investment property stacked on top of it, the costs can be excessive. Like the example I used, if your cost for compliance and admin and accounting and so on and so forth is $6,000 a year, but your super fund's got 100 grand or 150 grand or even 200 grand, you're looking at somewhere between 3 and 6% as your cost to simply manage the self-managed super fund. So when you're considering how you house your retirement plans, self-managed super funds do play their part. Self-managed super funds offer a great amount of flexibility. Flexibility also comes around dangers because there are less guardrails, which is why the need for a financial advisor is even higher if considering a self-managed super fund. to ensure that you get the right diversification approach from a professional. But small self-managed super funds are an issue. And if we're already seeing that in Australia, the average size of a self-managed super fund is 1.55 million, that isn't small. And so if you have a super fund that's less than that, especially if your fund is less than $500,000 in size, you could well need some navel gazing to consider where to from here. Because just because it's popular and just because your next door neighbor has one also doesn't mean you should have one as well. Now that's all that's been on my mind recently. As always, we welcome feedback and you can reach me directly at Jonathan, jonathan.wu@simonwu.com.au with any feedback. And of course, please remember to listen to the end of this disclaimer to note that what I've talked about today is not personal advice. Until next time, have a great one.
This podcast is not financial product advice and is intended to provide information only. It does not take into account the investment objectives, financial situation, or needs of any person. You should assess whether the information is appropriate for you and consider talking to a financial advisor before making any investment decisions. Any investment examples are for illustrative purposes only. The information is taken from sources which are believed to be accurate, but Simon Wu, Jonathan Wu, SMU Financial Planning, and Personal Financial Services Limited accept no liability of any kind to any person who relies on the information contained in the podcast. Unless expressly stated, none of the information should be taken as a recommendation. For more information, please visit www.simonwu.com.au.